China is in its Lehman moment as the property crisis has no road left to kick the can down. Evergrande is at its tipping point. The economy is shaky and heading towards Japanese financialization, where the only thing keeping things alive is a massive money printing machine. And in this video, I'm going to explain exactly what's going on, why they're suffering from a deflation crisis, and why it's so important even if you are thousands of miles away from China like I am. So a little bit of background here. China had a booming real estate market for pretty much the last 20 years. House prices were skyrocketing, with all of it really just based on pure naked speculation and nothing real. Home builders, house builders, these apartment builders were making tens of thousands, hundreds of thousands of new apartments every year and selling them mostly to investors, which would stay empty yet still somehow rise in value. And then after COVID came and went, that bubble basically popped and everyone stopped buying homes. House builders were exposed as these giant frauds with billions and billions, literally hundreds of billions of dollars worth of debt and worthless assets to supposedly back up that debt and protect it all. And Evergrande was the largest single failure of the entire Chinese economy. It went bankrupt with $300 billion in debt. The Chinese government halted trading about 18 months ago now, and they basically made a collapse of not only Evergrande, but all the other housing giants which collapsed as well, illegal. And now we're starting to get more information out from Evergrande, and as you can see right here, it's actually worse than we thought. Evergrande's debt hits $45 billion with restructuring ruled out. Basically, Evergrande is delisted from the stock exchange right now, which means that something like releasing new shares to repay that debt is now impossible. And they initially claimed that they had only $22 billion in net liabilities about 2 years ago. That number has now risen to $45 billion in net liabilities. And with a total of $300 billion in debt, they claim their assets are still sitting at around about $250 billion worth in real market values. But that's just not true. Restructuring that debt is now literally impossible, and that means that there's no more pretending there isn't a problem or pretending that this problem is solvable. We are going to see a mass liquidation of assets from Evergrande and a bunch of other housing giants as well. It has to happen. It is the last stage of this collapse that the Chinese government is allowing to slowly creep forward. And what that really means is that we're about to find out the true value of these assets, which these property giants have claimed have been holding them above the waterline for a few years now. And what we know for a fact is that Evergrande and these other property giants have been lying about the value of their assets. In many cases, they are entirely empty apartments in empty blocks in empty cities, many of which were never even built and only exist on paper, which are supposedly worth around $250 billion. And with liquidation now being the only recourse left for Evergrande and these other failing giants, those properties, they're going to be put on the market and they're going to try to sell them, and then we will finally get the true value of this entire bubble and this collapse exposed. Now, we're already expecting a $45 billion gap from Evergrande alone, and frankly, it's likely to be 10 times as big as that almost, since just a couple of years ago, the gap that they emitted was $22 billion, and now after looking in more of their papers, it's risen to almost, or actually more than double that. In my opinion, Evergrande alone will be looking at something in the region of $200 billion in losses. And then there are countless other property giants in the exact same situation, like Hengda Real Estate, who has been accused by the Chinese government themselves of fraud by inventing $78 billion in revenue that literally didn't exist. The total losses from all of these property giants collapsing together is likely to be in excess of $2 trillion US, which is absolutely monumental. And the ultimate problem here is that China simply can't fix this property crisis. And that comes down to one real key main reason: the infinite growth, or the seemingly infinite growth, that we saw in the Chinese property market over the last 2 decades was never sustainable. First of all, it was driven by urbanization, by literally hundreds of millions of Chinese people going from rural villages to urban cities, and they're getting better paid jobs and they're getting better educated, and they're entering the housing market for the first time ever. They're buying up apartments, but that urbanization is now mostly done. So the growth from that that the property market was expecting to see forever somehow has now dried up. Then we have China's literally disastrous one-child policy, which stunted their population growth before, and now it's caused population collapse. Their population, China's, is actively falling every year already. Minus 1.4 million people on the government's dated and frankly fraudulent figures last year alone. $2 million expected to be announced by the Chinese Communist Party this year, and that's going to accelerate to more than 10 million a year in less population every single year within a couple of decades, according to the Chinese Communist Party's false and fraudulent figures. And then finally, the demand for investment properties has just dried up all across China. In essence, the economy there and the finance markets were just really weird, and it's been borderline illegal, or at the very least incredibly difficult for an ordinary Chinese citizen who's trying to save for their retirement or just invest some money to put anything into the stock market or into the bond market. And so the only thing people really could do to invest their money was to buy property. That came with it a huge degree of safety and security, or apparent safety and security, that the Chinese population had around its property market, which is why we had these ghost cities that were still completely sold out. But after that illusion has fallen apart and the safety of the Chinese property market has been shattered, demand is at rock bottom lows, so there simply aren't any investors looking to buy in China anymore, which accounts for about half of their demand over the last couple of decades. And as a result of all this, property prices in China have been falling every single month for more than 3 years now. Now, investors had hoped that the Chinese government was going to basically bail out these developers and prop up that housing market bubble. And they have put out a few new laws and relaxed some regulations, but there have been no bailouts and there has been no massive support. When Beijing rolled out rules in 2020 to curb the excessive borrowing of property developers, it kicked off a downward spiral, pushing many real estate firms to the brink. But the government has stopped short of an industry-wide bailout, instead taking steps such as relaxing purchase restrictions and encouraging banks to lend more. Basically, the aim of the Chinese Communist Party isn't to do what they did in 2015, which was just to inflate the bubble again and make it an ever-growing bubble and an even bigger problem for the future. They made that mistake already, and that's what's created the problem they're seeing right now. So now all they really want to do is just to stop property prices from falling, and so far they have been failing in that endeavor because confidence in the housing market is simply non-existent, and without it, there's nothing really the government can do to save the property market. Now, obviously, this is not going to occur just in China. China is a massive economy that impacts every single country around the world because of their large and how much they export to the rest of us. And in one particular way, this actually presents an opportunity for people like me and you, because the United States under Trump is well aware of the risk that the Chinese economy poses to America and that their geopolitical troubles with each other pose to the American economy. And so they are actively looking to strengthen American supply chains and to import less from China. And that brings me on to this video's sponsor, Resolution Minerals, whose flagship project is the Horse Heaven project in Valley County, Idaho. Now, Horse Heaven is on the border of Perpetua Resources, a NASDAQ-listed multi-billion-dollar stibnite project, the largest antimony project in North America. And Resolution Minerals is making a US push with the Horse Heaven project as their flagship. It's 5,644 hectares large in one of America's safest mining jurisdictions, and the project already has a plan of operations approved by the US Forest Service for up to 59 drill holes at 19 sites. The company still sits under the radar with a tiny market cap of $70 million US, and with buyout offers of $225 million already before they've even started drilling. And on top of that, Horse Heaven is just one of their mineral projects. They've built a whole portfolio that is set to thrive in this current climate. Now, it's no secret that America is desperate to secure its supply chains and protect itself from an increasingly volatile geopolitical situation. And as just one example, in late 2024, China completely banned antimony exports to the United States, which which is essential for building products like bullets all the way up to circuit boards. Without antimony, America's supply chains are exposed to geopolitical risk, which is exactly why Trump declared critical mineral production a national energy, which is exactly why Trump declared critical mineral production a national emergency and ordered agencies to prioritize mining. Now, Horse Heaven's recent samples and historical data show 19.15% antimony, and with 5.9 grams per ton of gold and 230 grams per ton of tungsten and 367 grams per ton of silver, with historic production of all three of those metals during the First World War, the Second World War, and the Korean War. Now, Resolution Minerals is currently trading as RLMLF over the counter and have already received an offer of $225 million on the Horse Heaven project, and the company is currently trading at only a $70 million market cap, meaning this is still in its early stages with serious potential upside. Now, you can learn more about Resolution Minerals in the link down below in the description of this video if you'd like. Now, the ultimate problem with China's housing market here is that it has plagued China's entire economy with that bad housing market. Demand is falling in China and the economy is suffering, and there are fearful citizens who are terrified of spending money, so instead they're just saving money instead, because consumer confidence is just incredibly low, as it has been ever since the property crisis started, and this is causing something called an oversupply or an overcapacity issue, which is crippling the Chinese economy even further. Basically, there are too many companies making too many projects, and there's huge competition in every single market, with price wars all over the place, which is forcing prices down drastically, and so now deflation is rampant across China. And this graph here shows you exactly that. It breaks down deflation or inflationary price impacts according to each industry within China, and as you can see, over the entirety of the last year, every single quarter, China has been seeing deflation in almost every single sector. Now, that is a massively stark contrast compared to what we were seeing in the latter half of the 2010s, where inflation was actually rather rampant and massive figures, which was scaring the economy for that way, but now it's completely flipped. And the Communist Party is trying desperately to fight deflation by forcing less production, by literally forcing companies not to produce so much commodities or products or goods so that there's less of this oversupply issue and deflation hopefully goes down. Coal output declined last month from a year ago as government inspectors literally targeted sites that are producing too much coal. A major lithium mine was suspended for 3 months. Bosses from electric vehicle companies and some tech giants have been hauled before regulators and warned about over-competition. That's slowing China's industrial engine and hurting growth. Yet what's lacking is a recipe that worked a decade ago, when China's top leaders not only curbed output to prevent prices falling too far, but also gave households a huge wallop of stimulus, unleashing an estimated $877 billion in property investment, equivalent to almost a tenth of China's economy in 2015. Under that shantytown redevelopment program, the People's Bank of China provided over 3 trillion yuan of cheap loans to help local governments and developers tear down old homes and provide families with cash compensation. Households took on debts to buy new apartments. Such stimulus accounted for 60% of price rises in coal and steel, playing a more important role than mandated capacity cuts, according to a study by the International Monetary Fund, the IMF, in 2018. What this all means is that in 2015, China was facing the exact same problem they're seeing right now: mass deflation, prices lowering and falling every single month because the Chinese people are just not confident in the economy. And the way they actually managed to fix that wasn't by sending inspectors to coal mines and forcing them to stop producing so much coal. It was literally paying citizens to buy new homes to the tune of 10% of the entirety of the Chinese economy. Now, this time, the Communist Party is terrified of doing that again, because that is what caused the housing bubble to continue to grow after 2015 up until 2020, when it finally started to pop. And so they're fighting the exact same problem as they were 10 years ago, only with less than half of the tools they had 10 years ago. Now, why is deflation so dangerous? Well, when prices fall, people are literally incentivized to save money and not to spend money. Why would you buy a car today for $30,000 when it will cost $20,000 next year? Or the same goes for a boat or a new house or a TV or a pair of shoes or whatever it is. At the end of the day, money is just a medium of exchange, and it serves literally no value. It provides no value. It serves no purpose if it's just sat in a bank account or hidden under a mattress. It is only useful when it is exchanged for a service or a product. Saving isn't spending. It doesn't help the economy. Businesses lose customers, they fire staff, wages fall and prices fall, and you end up with this awful positive feedback loop. Deflation causes less spending because people are just saving to spend later when things are cheaper, which means that there's more deflation and then less spending further, and it just goes around and around, and it literally strangles the economy. Now, China is desperate to fix this problem, but it literally doesn't know how to without the massive stimulus and free money like they gave out in 2015, giving out literally 10% of the entire economy in just free cash to people to buy homes and prop up the housing market to try and get people to spend more money. And so what we're seeing here is China drifting towards a Japanification of their economy, where they are just literally incapable of driving growth because they are over financialized, and they've allowed these property bubbles to consume the entire economy. And now that they've popped, consumer confidence is dead. Now, of course, the trade war between the United States and China is having a huge impact as well. China's domestic economy is already weak. This deflation is causing citizens to spend less money, to save more money. That's taking money essentially out of the money supply, out of circulation, and companies out there are still producing loads, and they're flooding that market with their supply. There's not enough demand, which causes prices to fall, more deflation, and the cycle repeats over and over again. Now, there could be a solution here in the form of what China's also traditionally looked to do a lot of, in the form of exports, right? Just send those products overseas, send those electric vehicles or those commodities or other products, export them overseas to other countries, which would reduce that level of oversupply in China. Demand would not be so much greater, and you'd lower deflation and help to solve that problem. But the tariffs and the trade war with the United States is making that much harder. US is the single biggest importer of Chinese goods and products, and tariffs at over 50% is simply reducing American demand for Chinese products. Now, other nations are also incredibly cautious, and businesses all over the world, of the geopolitical risk of trading with China, of setting up your global supply chains to work with China, a country which we may well be at war with within a decade or two. And so deglobalization is also centralizing supply chains closer to home and making it harder for Chinese companies to export their goods and their commodities and their products and services overseas. So these products, these commodities, they aren't being exported, which is leading to even more supply in China, which is making the oversupply crisis in China even worse, creates more deflation and more problems. So that is a massive issue for them as well. Now, there is a tiny little silver lining here, which some people believe. Personally, I don't think we're going to see an end to the US-China trade war with a deal, but that would be a silver lining if it can be reached. Unfortunately, as we know, China is the primary target of Trump's trade war, right? Those escalations were huge earlier on in 2025. Total tariffs were higher than 145% between China and the United States at one point. And to export a chair, for instance, from China to the States and have to pay $1,450 in taxes on a chair that's only worth $1,000 completely destroys the economies of manufacturing in China. Currently, those tariffs are much lower, around the 50% mark for these negotiations. But America's stance on China is clear. America is the world's largest economy, the world's biggest power, and they want to stay that way. Every time China gets a little bit richer and a little bit closer, that diminishes the comparative power of the United States. The US has had very, very easy negotiations against Japan and Canada and Mexico and the European Union and the United Kingdom, and they've come out leagues ahead on every single example. But they actively want to hurt China to curb their power and their growth. They aren't looking for a deal to make America richer. They're looking for a deal to make China poorer. And China's stance on America is also very, very difficult. China's that growing power. They have a very nationalist government, and pride is incredibly important. And so winning a trade war is far more important for China than it would be for Japan or the EU or the United Kingdom. And so China's willing to damage their economy if it strengthens their national pride, if it keeps the people happy, because they're an authoritarian nation. And so public opinion is incredibly important to them. China also has a lot more leverage than any other country when dealing with the United States, which means they're less likely to settle for the increasingly strenuous demands that the States is making upon China. Yes, Trump's aim is to increase domestic manufacturing and to reduce imports, but slowly over the years, it's also to avoid inflation. And China, as that largest exporter to the United States, if those 100% tariffs return, inflation will follow for sure. China also has that rather rare commodity strength, which is very important for advanced technologies. There are 6 rare earth heavy metals, of which 100% of them in the world are refined in China. And of rare earth magnets, for instance, 90% of those produced and refined in the world are refined in China. So China blocking access of these materials to the US is an incredible piece of leverage. All in all, what this really amounts to is that China isn't feeling desperate to sign a deal right now, which is exactly why we've got that 90-day extension to that trade deadline, which came into effect in August. And so the next deadline is in November. But it seems incredibly unlikely that China and the United States are going to get a deal that prevents massive amounts of pain and hurt for them both. Even these 90-day extensions, we're seeing roughly 50% tariffs, and that's already hurting China massively, making this oversupply crisis 10 times worse than it would have been otherwise. And then Trump's trade war itself is just having that impact on China's economy with job cuts and factory closures all over China, as they just don't have anywhere to export their products to anymore. Ultimately, China's economy is in an incredibly tough position, and no one really seems to be talking about how large and wide impacting this is going to be. It is not just the case of China might have a recession for 5 years. What we're looking at here is China turning into the new Japan or the new Argentina, where they fail to see economic growth because of this over-collateralized economy and this over-financialized economy, which lasts for decades into the future. Decades of no growth, decades of no improvements in living standards, decades of a falling population, which makes it harder to inspire that growth, and decades of trying and failing to get people to have children, as pretty much every country in the world is suffering with right now. At the end of the day, yes, China is in a really, really tough spate, but no one's really focusing on the impact that deflation is going to have on their economy, and it is going to be massive.